So Broadcom just dropped a blockbuster quarter. I mean, the numbers were absolutely record-breaking. But here's the weird part. The stock actually stumbled. So what gives? We are going to break down a brand new BGVC analysis that argues Wall Street is completely missing the real story here. Let's get right into it.
First, let's just look at that headline number, a staggering $18 billion. For a single quarter, that is a massive 28% jump from last year. And you know what's fueling it? It's almost all coming from an absolute explosion in their AI business.
But this is the puzzle, right? You have this incredible performance, but the stock gets all wobbly. It just doesn't seem to add up. Well, the BGVC analysis we're looking at says investors are focused on completely the wrong thing. And what they're missing? Well, that's the key to this whole story.
Okay, this slide really gets to the core of that disconnect. The market sees one thing, a little bit of short-term pressure on gross margins from hardware sales, and it gets nervous. But the BGVC report looks at the exact same data and sees something else entirely. They argue this is incredibly short-sighted. They believe Broadcom is smartly sacrificing a tiny bit of margin today to build this huge, unassailable competitive moat for tomorrow.
So here's our game plan. We're going to start by exploring that paradox we just talked about. Then, we'll get into the dual engine thesis, which is really the heart of the report. After that, we'll dive deep into each of those engines, AI compute and the software cash cow. And finally, we'll wrap up by looking at valuation and, of course, the risks.
Right, so let's properly unpack this whole paradox. Because understanding this gap, the gap between Broadcom's amazing results and the market's kind of hesitant reaction, that's the first step. You have to get that before you can see the much, much bigger opportunity that the BGVC report is pointing to.
And that brings us to the core argument of the entire BGVC report, what they call the dual engine thesis. Their point is you just can't understand Broadcom's true value if you see it as a single company. You have to see it as this powerful machine with two totally distinct but perfectly complementary engines, and both of them are firing on all cylinders at once to build that incredible competitive moat.
And here are those two engines, right here, broken down by revenue. You can see 61% comes from their traditional semiconductor powerhouse, and the other 39%, that's from infrastructure software, which is now completely supercharged by that huge VMware acquisition. The key here isn't just that there are two parts, but how they work together. It's all about the strategy.
So let's dig into that first engine, the hardware. Now, according to the analysis, this isn't just about selling a few more chips. No, this is a story about a very calculated, very deliberate move towards almost total dominance in a really critical corner of the AI universe. You know, this single chart pretty much tells the whole story. While their non-AI chip business was basically flat, just chugging along, look at the AI-related segment. It exploded. It rocketed up 74% year over year. Folks, this isn't just growth. It's a fundamental pivot of the entire business happening right before our eyes.
So how on earth did they get that 74% growth? Well, by building what is basically a virtual monopoly. Broadcom is now the one and only strategic partner for giants like Google and Meta, and they've captured something like 70% of the entire custom AI chip market. Their technical barrier, their moat, is this incredibly deep library of essential IP. It's like the hidden plumbing that makes all these powerful chips actually talk to each other. And they're not even done. They're still adding major new clients.
Okay, now for the second engine. If the AI hardware is the high-growth, high-octane part of the story, the software is the powerful, stabilizing anchor. This part of the story is all about the masterful integration of VMware and how they're turning it into an incredibly predictable, cash-generating machine.
The BGVC report actually calls this cash flow alchemy. And you know what? It's been brutally effective. Step 1. They streamlined the product catalog way down to its core. Step 2, they forced every single customer to move on to a subscription model. And the result of those two moves, they have locked in a massive, predictable, long-term revenue stream. That is the very definition of a cash cow.
And the result of all that alchemy? Just look at this number. A colossal software backlog that has surged to $73 billion. That's basically guaranteed revenue sitting on the books, providing a level of certainty and visibility for years and years to come that most companies can only dream about.
And this is exactly where that two-engine strategy becomes so incredibly powerful. The chip market, as you know, is notoriously cyclical. It has these huge booms and then these painful busts. But this massive, predictable software business, it acts as a buffer. It's a stable foundation that just keeps generating consistent cash, which they can then use to fuel investment in that high-growth AI engine. It just smooths out the entire ride. So, when you have these two engines working in perfect sync like this, the analysis argues that the way the market values Broadcom is just fundamentally wrong. Let's take a look at how BGVC thinks it should be valued and, just as importantly, what risks could derail this whole story. To get to what they think is Broadcom's true value, the report uses a sum-of-the-parts model. They say, look, you should value the high-growth AI business with a multiple like NVIDIA's, and the stable software business with a multiple like Oracle's. And when you value each piece on its own merits and then add it all up, the analysis gets to a total enterprise value that suggests the company is being significantly underrated by the market right now.
This all points toward the ultimate goal for this whole investment thesis, what's called a re-rating. This is that magic moment when the market fundamentally changes its mind about what a company is. The BGVC argument is that the market is going to wake up and stop seeing Broadcom as just some slow, steady value stock and start valuing it for what it is, a premier AI growth stock.
But hey, no investment comes without risks, and Broadcom's are pretty significant. It is heavily dependent on just a few giant customers like Apple and Google. It has major geopolitical exposure, both to China and its reliance on a single manufacturer, TSMC, in Taiwan. And finally, it's making a huge bet that its chosen networking technology, Ethernet, is going to win out against the competition to become the standard for all future AI data centers.
Ultimately, the BGVC report wraps up with this really powerful idea. To truly understand Broadcom, you have to stop thinking of it as just a chip company or just a software company. The best way to think about it, the best analogy, is as a franchisor of digital infrastructure.
Think about it this way. During a gold rush, the surest way to make money isn't digging for gold, it's selling the shovels. Broadcom is selling the essential shovels, those custom AI chips, to the big gold miners like Google and Meta. But at the exact same time, it's also collecting reoccurring tolls through VMware subscriptions from pretty much everyone using the digital highway. It profits from both the boom and the underlying infrastructure that makes the boom possible. That is the crucial takeaway.
Which really brings us all the way back to that central question. As this massive AI wave continues to build, what exactly is Broadcom? Is it a stable value stock, just generating predictable cash? Or is it a high-octane growth stock, riding the AI revolution? The BGVC analysis suggests it's something far more rare and maybe far more powerful. A company that has actually figured out how to be perfectly and very profitably both.